Hello and welcome to Economy and Markets TV, where we have conversations with a purpose. I'm your host, Dave Oakenquist, Senior Research Analyst here at Dent Research. It is Friday, and this is the show where we take you around the world of economic and financial news, and that means I also bring on the editor of Boom and Bust, Mr. Rodney Johnson. Rodney, good morning.
Morning, Dave.
Great to have you here, as we do each and every Friday. This one, we pick about 3 or 4 topics that really seem like the most important items of the week. Try to keep things moving. We try to keep each item to about 2 minutes or less. And if Rodney goes over, he gets this bell. That means it's time to move on. So with that, let's begin with the what we thought was probably the most important thing. It's an update to the great trade wars of 2018. The U.S. announced a deal with Mexico, an agreement in principle to a new trade deal. Rodney, this one is mostly about cars. Some of the details under the hood are the requirements are that 75% come from U.S., Canada, or Mexico. About 45% are made in plants that pay at least $16 an hour. And then for the kicker, there's a 25% tariff on cars, anything exceeding 2.4 million units from Mexico. And just as a frame of reference, I know you guys love all these numbers. Last year, Mexico sent about 1.8 million, so they were under that number. So what everybody just really wants to know, Rodney, is this a good deal? And primarily, is it a good deal for the United States?
It's kind of the same deal we had, in that it doesn't change the metrics on the ground in terms of what people are doing, because there aren't many vehicles, or there aren't many high profit vehicles you think of that would fall under any of these thresholds. And so trucks, amazingly, Chevy makes a truck that's 46% made in plants that pay $16 an hour. So dodge that bullet. I'm sure that was not an accident. And so these rules were written to let most of the car companies do what they've always done. There are a few sedans where more of them are made in Mexico than in Canada and the U.S., and so they would fall under that threshold. But they're lower price sedans where it doesn't make sense to move the plant. You just pay the 2.5% tariff and move on. And so you treat it as the cost of doing business. Okay. And so it's interesting in that we got a little bit better deal. There's a trade dispute element to this, where if somebody's breaking this, there's a penalty that's easier to enforce. That's actually a better deal for us. But it shows that the cudgel that President Trump is using to beat on our trade partners is working. And you can tell this morning because the New York Times said it's working for now. They had to give you a qualifier, but they said, yeah, the guys actually brought the Canadians to the table. They're working on a deal right now, as a matter of fact. They brought the Europeans to the table who said, well, yeah, actually, we would kind of agree to what you want because we need this for our economies. And so, as you and I have said for the last several weeks, he is operating from a position of strength, and he's actually getting some movement our direction. So, yeah, it's working. They're not big moves, but they are moves, so we'll take them.
Yeah, absolutely. Yeah, and the news out of the EU that came out, because we had talked about, I believe, a couple of weeks ago about the U.S. talking about slapping tariffs on luxury vehicles from Europe, and I know you weren't very happy about that because you happen to drive one, Rodney. But I do remember the news that came out was that really, I think what the president said from the beginning is he wants reciprocal, and then if you can bring them all down, that sort of makes sense. And I think that's kind of the angle that we're working with Europe. And I think free trade between sort of like nations or like groups, that makes a lot more sense to me. So
seems to. But the main theme here is that we're operating from a very strong position with a growing economy where we got to go, trade wars, yeah, look at unemployment below 4, look at GDP growth above 4. We're in a really good place where the other nations are going, we're not growing as strong. Maybe we should really come to the table on this.
Yeah, absolutely. I know I'm running along, and this is me, but I do want to mention one last thing. It did come out yesterday that this rumor of this $200 billion, this is referring to China now, but identifying $200 billion to slap tariffs on. There's some news that this might actually happen next week, so we don't really know if that's going to happen, but want to keep you all aware of that. So with that, let's move on to our next thing, which is U.S. home prices. The U.S. S&P Case-Shiller Core Logic 20-City Home Price Index. I think I got that right, Rodney?
Yeah, exactly. All those words jumbled together, whatever it is. Yeah.
The news on this was that the annual growth slowed to 6.3% per year. The 20-city was down from 6.5. The 10-city down from 6.2% to 6%. Again, we get this idea of rising inventory, or low inventory, rising rates, and then we had last week's news of new home sales slowing. What do you make of this report, Rodney?
Well, people are talking about the slower growth in home prices. Let's put this in perspective. We slowed from 6.5% a year to 6.3% a year.
Right.
It's still an incredible rise in a very large asset in most people's world. And so there's still a good number. I'm much more caught by the slowdown in activity. I mean, if you only sell one house in an area over the course of a year and that house goes up by 10%, home prices look like they went up 10%, but you had no activity. And so it's really all about, can we keep this area of the economy going? And it's an inventory issue, right? It becomes, are people out there willing to sell, and do buyers have enough economic wherewithal to make the purchase? And so I think this goes back to something we've talked about really for 3 years now, which is we have prices outgrowing wages. And eventually that gets stretched to a point where you're just seeing the slowdown. And I think that's where we are. And so something's got to give. I think prices come back a little bit more, maybe not go negative, but certainly, the growth rate in prices slows down and you kind of reset a little bit at a plateau. But definitely this lower activity, I think it's because prices have far outpaced wages for years.
Yeah, absolutely. And to that point, like I said, falling from 6.5 to 6.3 reminds me of like Chinese GDP, where it's just so high that, a percent here or, a tenth of a percent here and there doesn't seem to make that much of a difference. So
right. When they go from 8.5 to 6.5, it's like they're still growing at 6.5.
Yeah, exactly. And one thing I did notice, though, just a little tidbits in terms of where prices have been rising. Las Vegas over the last year, 13%, which is the highest of the 20 cities, and Seattle, number 2, at 12.8% for the year. That's just screaming hot real estate for those areas. So, yep. Wow, that's just crazy. That's all we had for this one. The other thing we had was inflation. The personal consumption expenditures price index was up 2.3% over the last year. The reason why this one is significant is because this is the measure that the Federal Reserve uses for inflation, which is not the CPI from the BLS, which is really more the one that most people are more familiar with and gets more play in the news. They set that 2% price target, Rodney, and we're just a little bit over that. So what does that mean for Fed policy?
Yeah, the core PCE was at 2%, so it matched their target. And so this is really the big news of the week for me, because this informs what the Federal Reserve does with interest rates, right? And that's a really big deal, because we're going to get our third increase of the year, I believe, next month, September. And then I believe we'll get a fourth in December. And so that'll put us at a rate of 2.25 to 2.5 on the overnight rate. And you know what? You're getting really close to the 10% yield around 2.8, 2.85. And so you're making a really flat yield curve. And so what does the Fed do from there? If they have inflation, their own chosen measure of inflation is the best gauge of what's going on, at or above 2%. And remember, it's really hard to move prices. So if they've risen to 2, chances are they're going to go over a little bit. And so if you have those prices going up, I think the Fed's going to be in a real box of saying, oh, we're just going to sit on the sidelines. And so they'll start to worry the equity markets a little bit, because as they raise rates, the old theory, of course, is they raise rates, it takes some of the energy out of the markets because it makes debt more expensive and it slows down economic growth. Now, from these low levels, is that really going to happen that way? I don't really think so. I'm on record saying I don't think the flat yield curve is going to hurt us, but I do think it informs psychology, and psychology is what informs risk taking. And the equity markets in the short term are all about views of risk. And so this could lead to some pretty good volatility here at the end of the year and beginning of next year.
The interesting thing you said in the copy is that inflation tends to move sort of with the momentum, right, in waves and ebbs and flows. So, yes, we could be seeing, I don't know how high it could get, maybe another 0.5% if possible, if this is the beginning of that, or part of a wave going higher. So it's definitely something to keep an eye on. In addition to low unemployment and inflation, they also just watch general growth, as you said. And we had news that GDP from last quarter was revised upward just a little bit to 4.2%. And as of now, the GDP now estimate for Q3 is at 4.1%. So still showing signs of strength, right?
Yep.
Absolutely. All right, so that's all we had, just about all we had. We had one tiny little item. We want to take you to South America. Again, it's not Venezuela this time, but in Argentina, where the Argentinian peso is tanking. It lost about half of its value since the beginning of the year, I believe. This could be another one to keep an eye on, right, Rodney, in terms of crises around the world?
They really can. And the Argentinians are the ones that, they have their own line at the IMF bank window because they keep going back over and over and over again. The Argentinian government has gone bankrupt several times over the last 100 years. They go back to the IMF and say, hey, guess what? We kind of need some help here. And IMF says, man, you did this all wrong. You need to put in these reforms. We'll give you some money and bail you out. And the Argentinians go, great, we'll do all that. And they take the money and they don't make the reforms. And guess what? They have to come back. And so the current government, Macri is the president. He really got a bad deal in that he's taking over after Kirchner, who really screwed up the economy after her husband had screwed it up and then he passed. Things were so bad that it was illegal in Argentina to publish your estimate of inflation. The government literally made it illegal because they wanted to be the only ones that published it because union wages are based off inflation. And so when inflation was running 30-40% and they said, hey, look, it's really only 7 or 8, it meant that, of course, they didn't have to raise wages, which, of course, ruined the purchasing power of those workers. And so anyway, they've got a big problem. It's going to be very hard to get out. I think they will. I think that Macri has some good sense. He's tried to put in some decent reforms, but it will take time and it will take more money from the IMF. There's no question.
Yeah, absolutely. And as you mentioned in the copy, interest rates are at 60% inflation.
60, not 16.
No, 60.
60. Yep.
Yeah, that's that's a huge number.
Yep.
So it's definitely something to keep an eye on. Hopefully they can solve that situation until it happens again. Looking ahead to next week, we've got Labor Day weekend we're getting into the Labor Day weekend. So Monday, enjoy that. In terms of news, we've got factory orders, car sales, and the big one will be on Friday with U.S. employment. So looking forward to that and seeing you there next Friday, Rodney.
There's actually one more thing that came out this morning. The Houston-Galveston area, which is exactly where I live halfway between the two, they just passed the point where they export more oil than they bring in. And so this is the major place for oil imports. And so the fact that we've passed the point of more going out the door than coming in is a huge milestone in the U.S. energy complex. Yeah. And I think it's indicative of things to come. And so we should be hearing more about that. It's something I've written about in the past, where we're going to become an exporting nation. Maybe on paper, we're going to be a full exporting nation. It'll never be in reality where we don't bring any in because of the way oil grades are done. Right. But anyway, it's a very interesting movement in the field and one that we're going to keep an eye on.
Excellent, Rodney. Thanks for bringing that up. And thank you all for watching. We'll see you next week.